In our session today, we'll talk about life insurance products, both fixed and variable. We'll take a look at the free look period. We'll talk about policy calculations, and we'll wrap up discussing what a viatical is. First, let's take a look at fixed life insurance products. A term life insurance product is a temporary insurance that has no cash value. With a whole life policy, the cash value can grow if invested into the general account. It's invested into the general account and it's not considered to be a security. With universal life insurance, it's like a traditional fixed policy with an added annuity to it. And so your contributions, your payments into the insurance can be flexible and your account grows cash value like a whole life insurance product. I suspect our questions on the Series 6, whenever it's about an insurance product, will come from variable life insurance and variable universal life. So with variable life insurance, it grows cash value, so it can get higher than even the death benefit. And the reason for that is because we're investing in a separate account, and that separate account invests in securities in the secondary market. You can borrow money against your policy if you need to, and there are no taxable events if you borrow money. It's a loan. Also, with a variable life insurance policy, you have several different investment options, as if it were a variable annuity. In variable life insurance, the investor has the right to vote. Variable universal differs in the fact that it's like term life with a variable annuity. The contributions are flexible, and it also grows cash value, and they can borrow against it. So again, there are no tax events if we borrow money against our life insurance policy. It also has the right to vote, and we have several investment options to pick from so that we can diversify our retirement money even more. Variable life insurance and variable universal life insurance require the delivery of a prospectus. Variable life insurance and variable universal life require the delivery of a prospectus according to the Act of 1933 and the Investment Company Act of 1940. Variable life insurance gives investors a free look period. So if I have just recently took out a variable life policy and I'm like, hey, listen, investing in the market is a little bit too aggressive for me. I'd rather have a traditional whole life policy. The investor can do that without having to go through any of the actuary measures again, which would be like blood work, EKG, physical, things like that. They're going to waive all of that if you want to transfer it over to a whole life policy within the first 2 years. And they'll do that for you without penalty. Policy calculations for a variable annuity. The NAV is going to be calculated daily at the close of business, similar to mutual funds. The cash value of your contract is calculated monthly, and the death benefit is calculated once per year. So let's talk about a viatical settlement, which is a life settlement option. These are traditionally something that the insured, who is also the policyholder, they do on their insurance policy when and if they have a terminal illness. So what happens is a third party or an insurance company or another type of company comes in to do a viatical with the policyholder. In return, the policyholder gets a lump sum distribution of money so that for the last days of their life on this earth, they can spend it however they want to. The third party that did that, they now become our beneficiary, and they are making all the premium payments into the policy so that when the insured dies, the third party gets the death benefit. So what's the problem if you're the third party doing the viatical? You still have to wait for the investor to pass away before you can receive the payout. So again, these are usually only seen when somebody has a terminal illness and they want to use that life insurance money to benefit their life before they die. That wraps this up. We've talked about life insurance products, both fixed and variable. We've took a look at the free look period, talked about policy calculations, and we've also went over viatical settlements. That concludes our session for our Series 6 exam prep top-off series. I'll see you in the next video, moving forward to our next chapter.